Welcome to The Hard Truth. I'm here with Mit Perin.
I think a lot of people tend to forget that going to real estate full-time means you're going into a business full-time. And that takes probably a year or two of probably losing money or not making really any money because you're really putting it back into the business.
As an accounting specialist for real estate investors, what is the hard truth about why people are failing?
We're both here with the common goal of getting your taxes and stuff like that done. I understand that your coach might have told you to be on top of your contractors and the people you're working with. This is a business relationship, and I expect you to speak to me as a professional. For a while, we had a lot of people who would be like, oh, we need your services because you've been highly recommended, and then you're getting talked down to. A big portion of it is that a lot of accountants who end up growing their practice, they deal with this, and what they end up doing actually is they end up letting go a lot of clients as well.
Welcome to The Hard Truth. I'm here with Mit Perin. Mit is a wealth of knowledge, incredible real estate investor. We're going to dive into investing in real estate accounting, just general information and knowledge, as well as the kind of some of the intricacies of a private real estate trust. So stay tuned and look forward to the show. So Mit, talk to us a little bit about what got you into real estate, where you started and where you are now.
Yeah, for sure. So how I got into real estate, well, first and foremost, I grew up living in apartment buildings. And then when I went to university, I lived in a student house with 7 guys, and I was paying like $350 rent. And I was like, how the hell is this landlord making money? There's no way. And I was a CPA by trade, so me and my buddies, what do? We pull up our laptops and we start running numbers and seeing if it makes sense. We had co-op jobs at the time, so we're like, oh, we can actually like feasibly make this work. But like normal university students, we blew our money drinking beer and other stuff, so paying for tuition. So we had none for actually buying a place, and then ended up full-time working downtown at PwC. And while I was working and getting my CPA designation, I knew I kind of needed something more passive, something where I could like generate wealth and create income, where real estate kind of was like the natural choice just due to what I was exposed to and just seeing. While all that kind of happens, I said, well, what can I get in like Toronto GTA? Nothing really made sense. And then I continued my career from PwC to a smaller accounting practice, which then took me to London, Ontario. During that time, I got to meet Matt McKeever, a couple other real estate investors. And I was like, oh, people are doing it out here. But actually, when I first met everybody, nobody told me they were doing real estate investing. But I was just naturally asking about what is the London, Western market like? Does rentals make sense? And I think I got camped out there for like 6 months in like the Delta armories in London. So I was like, okay, maybe I can do something, buy a property, make it work. I ultimately ended up actually, after I think a year, joint venturing into a duplex, where I was just a passive partner and I had an active partner, and then I got a fourplex the exact same way. Then my active partner no longer wanted to be active, and so I had to sort of take over. And you have to remember, at this point, I'm just like an office worker. I do taxes, accounting, and all of that, but I don't actually deal with contractors, property management, all of that. So that was like kind of my first exposure into it. And then as I transitioned and started my own accounting practice with Pearson, we ended up focusing on real estate investors and helping everybody from single family homes to apartment building developments, investing in the US and all of that. And during that time, I was also doing all of those different things because real estate is sometimes like a shiny object syndrome is really easy to get into, right? And I was doing Airbnb arbitrage in Toronto before Airbnb arbitrage was a thing, but you soon realize your hats can only be in like one. You can't really have your hands in too many buckets because you don't have enough time to kind of really focus and grow in one area. And then just focus on my accounting business, and I was like, wait, all my accounting real estate investors are making so much money, and I've stopped to go make accounting money. I think I need to like reprioritize. And so that's when myself, Jeff Weibo, Matt McKeever, and PV started Foundation Capital. Now we have the REIT with just the 3 of us. And we're just focused on buying 3-story walk-ups in southwestern Ontario, predominantly London, St. Thomas, Chatham area, where we're taking buildings that are from the 60s to 80s and just bringing them to basically brand new standards on the inside. So just executing the burst strategy for investors and ourselves.
So not too much.
Sorry.
So haven't done too much in the last few years. Let's unpack. Let's unpack this. Let's go back a little bit here. So let's start with one of the first things that you did that kind of stood out to me. You did a traditional joint venture, duplex and a fourplex.
Yep.
You were the money partner.
I was the money partner. I was on title.
So you were on title.
And I put the money down for it, and I let the operating partner just manage it.
Okay, so they were the sweat equity in the deal. You were the passive investment. What happened there?
Well, the BRRRR got executed, and then it was kind of like, hey, we're done, or they've executed their part. And then as stuff came up, it was sort of like, hey, you can just like deal with it, kind of thing.
Did that person still have equity in the deal?
I ended up buying them out later, but it happens on both sides of it. Like even as we got into apartment buildings at first, we did some joint ventures as well. And what you realize is both from an operating, like an active partner and a passive partner, when you're first going into it, you've sort of set out, hey, this is what I kind of want from the project or what we're going to do. And this is where I see it. I see it going like 5 years, 10 years, or like lifetime kind of thing. Well, time goes by and people's priorities change. They have other focuses. They just don't have enough time.
Life happens.
And yeah, life happens, kids happens, things happen. So then you're like, wait, when we set this JV up, it was for a forever place. Now things are changing, and now roles and responsibilities are changing. We've got to kind of like pivot the situation. Fortunately, I was able to speak to the other person and actually come to an agreement where I was able to like buy them at a reasonable price. And I ended up taking it over more out of necessity than like desire. But I will say it was that experience that really gave me that hands-on experience to actually be a real estate investor.
Yeah.
Obviously partnering with them in the beginning was because even though from a theory perspective, and I worked in asset management from Dream Unlimited, we did like an asset management understanding where you look at the numbers and you assess if it makes sense. But again, I didn't have the network with contractors, tradespeople, property management, all that stuff. And then, we came to an agreement on that one, and we were able to kind of go away from there.
So it's still a happy breakup.
It was an amicable breakup. Obviously, at the time, it was probably feeling a little more crazy than it was, again, because you're thinking this is going to go forever, you're not going to have to do certain things, but when push comes to shove, either you're going to like crumble and say, okay, well, what am I going to do? Then just sell all the properties, and depending on the time of the market, you might not make money, or you say, hey, you know what, I'm just going to roll up my sleeves and take over the project and manage it, right?
It sounds like some of the learnings there were the foundation to some things that you did later. Is that fair to say?
That's very fair to say.
We'll dive into that later, but I talk all the time with these traditional JVs, these little duplex, fourplex JVs. I did them. It's how I got started. But realistically, they are not a scalable way to do a business. It's not. You do what you got to do to get into it, but as quickly as you can get out of those type of deals, the better. Moving into more professional structures, mutual fund trusts, limited partnerships, that's really the way these need to be set up, where it's not just an understanding, it's like a bound agreement, like legal structure. But let's go back. So you did the twosies and foursies, went okay, made some money, learned a lot.
So then started doing flips in like the Toronto GTA area where, again, going back to running numbers, understanding, hey, we know what the renovation costs are for certain things. So myself and PV started doing that in Toronto as well.
So you're a GTA guy, right?
I'm a GTA guy, yeah.
You're a GTA guy. You did a couple deals.
So until I came to London, Ontario for the audit, I didn't know what London, Ontario was.
Okay.
Right. I knew what
the world ends in Milton for you GTA guys, right?
I didn't even know Milton. I got to like the end of Mississauga, to be honest,
Yeah.
right? And it was sort of like, oh, London, Ontario, that's where like, the Western University is, and like hospitals or whatever. And like people I met in university were like, I went to Brock University, so we had people from London, from like Sarnia, Windsor area, and they're like, I'm from here and here, and I was like, I don't know what you're talking about. GTA is the world, right? And that's where you invest, because everyone kind of invests where they know, right?
Yeah.
But I took the chance because I guess coming from a numbers background, when I ran the numbers here in London as well, it made sense. And when we look at different markets today, that's exactly what we do as well. And at times it made sense in the GTA. I've made money on flips and I've lost money on flips. So I'm definitely not the best flipper. And that more or less comes down to everything a flipper will tell you, like don't get emotionally attached to the property and all these things.
Don't over renovate.
Because then you start thinking like, well, it should be just, putting lipstick on a pig, but I'm like, no, someone's gonna live here, so you gotta do it right or do extras. And then all of a sudden you're like, oh shit, now I'm going over budget on this, and it doesn't really make sense, right? But that's because I was thinking, okay, that's going to the end homeowner, right, for a longer term.
So this is such a powerful thing for the GTA folks, and I've been dealing with, I'm originally from Kitchener-Waterloo, that's where we are today, and I've been dealing with GTA investors and helping them understand that, beyond Milton, there's a little town called Waterloo with a little company called Google. There's some real, London is the 11th largest city in the country. There's some major infrastructure beyond the GTA, and your dollars go a lot farther in terms of investments as we go down there. We'll talk about how that ties into Foundation, because I think that's a key part of Foundation's model. But what I want to talk about before that is, we're seeing a lot of people who are so gung-ho to be full-time real estate investors right away. And how that's turning out for a lot of folks is not necessarily good. You had a job, started investing in real estate, then created a business, an accounting business that was centered around real estate. And a lot of that was around making sure you're making income while your investments are getting started. Talk to me about, I'd love to hear why you stopped doing the accounting, and how you knew based on the numbers that it was okay, it was safe to take that step.
100%. So I think it's very easy to get caught up in social media and people saying, oh, I was in my corporate job for 20, 25 years, started investing in real estate, now I just do this full time, I'm retired, it's all good. When I started investing in real estate, it was supposed to be something passive for me to just be able to grow my wealth and create that income. But even as I started to do other deals when I went to self-employment, deals take time and money. And you don't know when capital calls happen, and you have to be reserved for that. And I knew from having my hands in multiple pockets of different things, of doing flips and stuff like that, investing in the US, all that, I need to keep turning out cash in order to be able to fund these things. And I had taken on private loans previously as well, but you have to be able to service them and also service your lifestyle. So when people look towards early retirement or retiring early or retiring, they usually set aside emergency funds and a certain amount of savings and stuff like that. So I knew hey, I have that set aside, but some of these capital calls can be quite intensive, tens of thousands, 20,000 to maybe $50,000, $100,000, depending on the deal that you're working on. And sometimes you might have to hold the deal for longer than expected. So now you're going to burn probably another $100,000 in holding costs, depending on the scenario. So it took me a while of saying, hey, look, I'm just going to keep staying in the accounting business. I'm helping a lot of people. I'm getting exposure, and I can see whose strategy is really working and who's not. The numbers don't lie. When you're doing your tax return, you're filing, and people are saying, oh, I'm making some XYZ on flips. You're like, this is really what the real number is, and you're looking at what they're actually spending on renovations and all of that. So that kind of exposure kind of gave me an understanding of hey, this is how much money I need to be able to set aside or be able to generate for me to actually go into real estate investing full time. I think a lot of people tend to forget that going to real estate full time means you're going into a business full time, and that takes probably a year or two of probably losing money or not making really any money because you're really putting it back into the business. And honestly, when I started the accounting practice, sure, it's a service-based business where it only took my time initially. But as we scaled and grow, we had to hire on more staff, more people, more software, and all these things. And what happens is you have people turnover. Your accounting business is directly translated to how fast you can service clients. Obviously, I hold myself to a pretty high standard. So when I was servicing clients directly and on my own, it was a lot easier, and I could get back to them right away. Once you have staff, they get overwhelmed, they don't have as much experience, things take time longer, then sort of you don't want your reputation to be impacted as well. So I finally, I guess, got to a cross point in the accounting practice where it was sort of either I'm doubling down and going to buy out a couple of firms to really scale and grow this thing, But accounting businesses are valued 1-for-1 on revenue dollars generated. So it's a really low multiple. Whereas with real estate, especially as we were starting to focus on apartment buildings, I knew that, hey, after a certain number of turnovers, each turnover would translate to about $250,000 in value. And and doing that took a lot less time and a lot less effort than doing, 20 corporate returns and hand-holding people through their personal tax return, or when the CRA was reassessing them. It just didn't really necessarily make sense. And with the access to internet and information, a lot of people would take whatever we're saying, go to their own accountant, implement it, have issues, come back, be like, oh, well, you said this. I said, no, well, if you were my client, I would have told you X, Y, Z. Or I'd advise clients like, hey, is this really what you want to be doing when your goal is X? You're trying to do Y, and ultimately it was very time consuming, I want to say, to the point where the last busy season, myself and PV, literally, we want to say worked to the bones, where literally my bones were physically hurting because I was doing 16, 18-hour days typing on a computer, and I'm like, oh my God, this is carpal tunnel syndrome. It's brutal.
Yeah.
I'm not spending that many hours necessarily on real estate in front of a computer typing and sitting and doing that. A lot more of it, what I do now, is a little bit of that on the computer for a couple hours a day, but otherwise a lot of phone calls, coordinating with people, coming podcasts like this, present to others, and just sort of managing the overall strategy of what we're going to execute, and then doing those individual parts that are required as well.
So we call it the hard truth. So we talk about, what are some hard truths? And there's some specific hard truths I want to ask you, but I'm going to ask you one specifically. As I know you're not active, but an accounting specialist for real estate investors, what is the hard truth about why people are failing on the accounting side of things?
I'll tell you, for sort of any accountant really, is that it really relies on your client to provide you that information, to be organized, to have that together. So I remember when we first started our practice and I was telling people use Google Drive, use Expensify and all these apps, people are like, no, can't I just give you a shoebox? And it was sort of teaching them no, this doesn't make sense. That's not really where the value add is. If you want me to go through your box and add up receipts, you can get anybody off Kijiji to do that for you.
Yeah.
Where the value and expertise comes from is, hey, this is actually a capital item in nature versus expense. Hey, have you thought of structuring your investments this way? It helped that myself and PV are both real estate investors, so we understood, how the banks would come approach you for financing and stuff like that. So, you can only have a certain number of properties under your personal name, putting in stuff in corps, what the costs of that are. And unfortunately, most accountants, if they're not a real estate investor and you're an investor dealing with them, they get frustrated. A lot of people turn them away, or they'll file your return incorrectly and let you deal with the consequences later on, right? So that's why I guess it's important to have an accountant who is an active real estate investor, not they own their own single family home and they're buying a cottage. They're not necessarily going to know the details exactly what you need to do. And then from an investor standpoint, I think there is basically two types of investors, right? It's because there's only two types, but there's two types because of a lot of the coaching programs, things like that. For a while, we had a lot of people who would be like, oh, we need your services because you've been highly recommended, and then you're getting talked down to. And it's I understand that your coach might have told you to be on top of your contractors and the people you're working with, but this is a business relationship, and I expect you to speak to me as a professional and work with me or work together towards the same resolution. We're both here with the common goal of getting your taxes and stuff like that done. So a big portion of it is that a lot of accountants who end up growing their practice, they deal with this, and what they end up doing actually is they end up letting go a lot of clients as well. Because what happens is the more notoriety or more you're known and the more you're doing well for others, you can get rid of the people that you don't want to work with. And unfortunately, I guess the bias works out that those not so great people end up getting together and being like, there's no accountants out there, and you're like, no. There's plenty of accountants out there. They just don't want to work with you because of how frazzled you are. I think a big thing that a lot of real estate investors, and I think a lot of Canadians in general just need to know is taxes aren't scary. It's pretty straightforward. There's a whole reporting system. even if you're a few years behind, just go sit with your accountant, explain what's happened, and just get your documents in order. Get a checklist from them. If they're not sending you a checklist, get a new accountant. You need to have a checklist. You need to get your documents organized. If you don't have them from your APS stuff, you can go request that from your lawyer. Get that all put together. Just get your stuff caught up, and it's pretty straightforward.
I see it on the mortgage side when people are complaining about their accountants. And I usually can tell them pretty quickly by the documents they've given to me why they're having a problem with their accountant. So and I say, before you go find a new accountant, get your shit together. Because I can tell by the documents that you've sent me that your accountant got a shoebox. And they're not able to give you accounting advice, they're giving you bookkeeper data.
Exactly.
They've inputted everything, and they're frankly tired at the end of it, right? They've done all the bookkeeping and the data, and now they're drained to give the accounting advice.
100%. And then even outside of that, a big piece is that if you're not having your financial information put together and you're not reviewing your portfolio like that, like on a quarterly basis, you don't even know how your portfolio is performing. So you might have these numbers in your head of what you think things are worth and what your cash flow is, because you're probably biased to remembering all the rents that are coming in, but are you thinking about all the outflows, all the outstanding bills you have? Which is why, even I've been, a person of this where I leave accounting to like the last, is because it's not a revenue generating item. So people always leave that to the end, but you need someone handling it and managing it so that you are reviewing it on a quarterly basis. If you're not already, and you're already a real estate investor with a number of properties, you really need to be doing that. So hey, this is a little bit of accounting, but it's more like finance, knowledge, wealth building thing. Is like, am I really going to see any more appreciation in this property, or should I just sell this thing, unlock the equity, and go redeploy it elsewhere, right? And I think a lot of people don't think about that or try to do that, where it's like, you know what? If you bought a property for 200K and you pump like 50K into it, and now it's worth 500, and everything in the market is kind of somewhere between 400 to 500, and there's no signs of it really going up, as soon as it hits that, you're probably best to just sell it and redeploy that capital elsewhere.
Talking a lot about it with different investors on the channel here, and it's a lot of us are buy and hold investors, but everything's for sale.
Yeah, of course.
Right? Everything's for sale. Like, listen, I want to buy and hold, the cash flow, it makes sense, but at the right price, if I could take that capital and put it into another value add project that has a higher velocity of capital, that's what I'm going to do. That's what makes sense. So I know that Foundation is very good at that. Talk to me about, I want to talk to you about a couple things about Foundation Capital. First of all, meeting with so many guys, and it's clear to me that the people who are having massive success are partnering with other top tier people, and you've aligned yourself with some top tier people. I also love the fact that you said we buy 3-story walk-ups. You talked about earlier, shiny objects, term. Now you buy the ugly. Tell me about Foundation Capital. What are you guys doing? How are you having success? How are you weathering the storm? What's the future look like? Talk to me.
Yeah, 100%. So about 5 years ago, we decided we should get into the apartment building business. Because what happens is, if you're sticking to duplexes and fourplexes, the deal value and deal size can only go up so high. The 3-story walk-up market and the apartment building market has a different range of investors. You've got the really big apartments that are over 100 plus units or communities. Those are typically being bought by public REITs who have access to capital at like 1 to 4%. So they're able to go 50% down and buy these buildings in like areas like the GTA, Kitchener-Waterloo, etc., where they're going to just park their money and just make that return, and they're happy with it. So for us, obviously, we saw a lot of success in buying, older buildings or older properties initially, renovating them and increasing the value. And when we got to apartment buildings and the financing around it and the valuations of how buildings are valued, it became pretty apparent that it's actually very mathematical. How you value a building is based on, obviously, like cap rate, but really the net, based on the net operating income it generates and what other buildings or what other units are trading for in size. So when we looked at, hey, what does it cost to build a brand new 12-plex? Well, it works out that it's like north of 250K in the London, Kitchener-Waterloo area, but if I buy an existing one, I could buy it anywhere between 140 to 180, 200, and be able to drop anywhere between 20 to 40,000 to basically have it brand new. And so it really became an arbitrage amount. It's like, okay, well, depending on the market, whatever it costs to build, if I know this is what it costs these developers to have a final finished product that is 300 a unit, and I'm spending X amount on renos and X amount on holding costs, then this is what I can reasonably pay on a price per unit. And this is the value that I can unlock as I continue to get turnovers. So the way we look at it is, if you have a building that hasn't been turned over at all, typically you're not going to be buying it based on the net operating income. You're going to be buying it on a price per unit basis. But as you value a building on an average in like secondary markets, you're looking at sort of like a 5-6 cap. On a 5 cap, each $1,000 increase, actually $1,000 a month rental increase, translates to about a $250,000 value increase. So once I started doing the math, even when I had the accounting practice, I was like, holy shit, you're telling me I'm going through like a lot of hours, long hours, brutalness, dealing with, not so great clients. Amazing. I had a lot of amazing clients. I've, great practice. Met a lot of people through it. But obviously I had to deal with the not so great ones. And I said, even with dealing with all that, the net take home after taxes and all that, you're looking at best case, a couple $100,000, or I can turn over couple of units a year and you can clear over $1 million. So it was sort of the obvious answer, but a big piece of that was you have to get the turnover. So while we started doing the apartments, I still had the practice for a while. Jeff continued to be a realtor. PV continued to do accounting with me as well. And part of that was we needed to be able to fund our operations as capital calls came up. So after about 2.5, 3 years, we knew that whenever we buy a building that's anywhere between 12 to 21 units, we could probably turn over about 50 to 75% of the building to market rents, which means we could generate anywhere between $500,000 to about $1.5 million in value, which is what led us to even executing on the strategy in the first place. And when we were doing that initially, we were doing that a lot with some JVs for our first few deals. But then after that, we were using our own funds along with private lending to cover our renovation costs. And I'm sure a lot of people ask you like, oh, why would I go to a private lender? I'm going to go to the bank. Well, a bank looks at net operating income of an apartment building. And so when you're buying it, sometimes you won't even get 40% loan to value. So it doesn't make sense. So then you have to factor in your numbers. Am I going to pay like 2% in lender fees, broker fees, and like 12% in
and broker fees,
and do that? Hey, lawyer fees are what kill you. Forget about broker fees, the lawyer fees, because you got to pay for the lender's lawyer and stuff as well, right? So a lot of times people don't factor those costs in, and they always think I'm going to get that turnover within 6 months, and it's like, man, like we're really good at it, and it still takes us, a year or two to get there. So most of the time now we're looking at a 24-month horizon and factoring in, okay, it's going to be a 1-year term, then it's going to get renewed, you got to repay those broker fees, you're going to pay all these costs, and you factor that in. And for a lot of people, when they're not able to do it, or when the market is like it is now, where it's sort of flat or it's actually gone down a bit, especially from with cap rates going up, people who weren't doing anything saw their property taxes and utilities go up, and their rents kind of remain the same, and cap rate go up, their building values actually got appraised for lower. So then people have to either come up with the cash, which if they're already highly leveraged, they're not able to do so, and then they end up selling for a loss. So honestly, for most people, it doesn't really make sense to be a apartment building investor, because you've really got to focus on it like a full-time job and be able to spread their risk across multiple properties. And so we had a lot of private lenders who lent to us over the time, and they were really interested in being able to invest. And we did the whole JV route, but like we talked about earlier, as time goes by, people's intentions change. They might have to exit earlier. They need liquidity, which is what led us to launching Foundation Capital Private Real Estate Trust and allowing people to have both exposure to the cash flow of real estate and the equity upside in apartment buildings without having to do any of the work themselves.
And we're seeing this as the reality for most people. A previous guest that I spoke with, we talked about, getting into real estate right now as a new person, do you want to grind it out on a duplex, or do you want to partner with a REIT? Do you want to private lend your 25K on a single second mortgage, or do you want to park it in a fund that does this every day? So there's really becoming a separation here that people getting in, if you're high net worth, maybe you just want to park right away. If you're new getting started, you could park money in funds that are performing in the higher echelons of real estate, and you can. It's amazing what you can learn even from your updates. Like when you guys send your newsletters and your updates, this is what we're doing, this is what we're turning over, this is how it works. If you're investing, you're like, wow, I'm seeing this return, and look like getting this, you can learn while investing with pros like you guys. So
yeah, a big thing of that, I think you hit the nail on the head, is you get diversity, right? You're not in a single producing asset. Like, unless you tell me you somehow know who the next NVIDIA is and you're going to park all your cash into it,
yep.
Very likely in any sort of deal that you just park 100% of it in, it's not going to outperform spreading it across like a private lending fund or a mortgage fund or across a couple REITs.
Yeah.
Because what happens, especially for us in our REIT, we have multiple apartment buildings in them. So it doesn't need to be that in this one building we need this many turnovers. We just need to, for you to see your return, there just need to be turnovers across the portfolio, which is a lot easier to happen.
Yeah. Mit, really appreciate your time today. Appreciate all your insight. It's super beneficial. We'll make sure we link Foundation's details in the bottom. So if you guys want to work with Mit, work with the guys, they're just a great group of guys. And really appreciate your insight and your expertise that you brought on the show today.
Thanks, Kyle. Appreciate it.
Okay.